Hey, good afternoon. This is Gary, the Indie Wealth Coach, with a little retirement planning tip for everybody. If you look on your screen, we're going to discuss today the Smart Retirement Money Order, which in layman's terms is the order of which our money should go back for retirement. In other words, we should take our first dollars into the first section and our third and fourth dollars into the other section. So let's talk about this order a little bit and what it all involves. First is we have our free money. Second, we have our tax-free money. Third is our tax-deferred money. And fourth is the taxable money. Now let's break this down a little bit. What is free money? Well, free money is any money that we would receive in an inheritance. And also, free money is any money that our employer puts into our 401k plans for us. A lot of employers will put a portion of their funds into our 401k plan to provide for retirement that is pretty good for us in the future. So we want to take care of any, or take advantage, I should say, of any free money that we can grab a hold of. Number two is any of the tax-free money. Now, tax-free money is going to come from investments such as a Roth IRA, insurance with cash value. What's not listed on here is also any municipal bonds that may have some tax favorability for us to get income from in the future. So we want to take care of providing our retirement plan with the tax-free money. The third place we should be putting our money would be in the tax-deferred bucket. Now, the tax-deferred is our traditional annuities, our IRAs, our tax-qualified plans such as our 401k and IRAs, etc. So anything that we are delaying tax on today to pay a tax on in the future would be the third area of which we should put our money in. And last is the taxable money. Taxable money, of course, is the money that we make in our wages. That's the money that we earn as a living. Any capital gains that we may get from investments such as real estate investments, stock market, things of that nature, or any 1099 interest. Again, what we're looking at is the Smart Retirement Money Order. So picture yourself in your retirement years. The first money we want to be pulling from is the money that we receive free, which would be the first dollars that we get from inheritance, etc. The next money we want to start pulling income from would be the money that is tax-free. Why would we want to pull from tax-free money instead of tax-deferred money or any of the other categories? Simply this, tax-free money doesn't jeopardize any money that we receive from Social Security, barring any changes in the Social Security system, which is another conversation for another day. Now, what most people tend to do is they tend to skip over numbers 1 and number 3. In fact, any contributions that people put into their 401ks above and beyond any dollars that is matched by their employer completely skips the tax-free money, puts everything right into tax-deferred money. To show you a little bit of an impact on that, let's take a look a little bit at the difference between what a tax-deferred plan looks like compared to a tax-free plan. We have our traditional IRA to the left and we have our Roth IRA to the right. Now, if you'll notice, what we're doing is we're putting money into a traditional IRA. We're not paying tax on any of the deposits. The growth in the bucket is growing tax deferred, which means 100% of what's in the traditional IRA will be taxed someday as ordinary income in the future, which we're putting this money back for retirement. So we're going to be paying tax on that money when we retire in our non-wage working years. On the Roth IRA plan, for example, we are using after-tax dollars to create the deposit. Since we're using after-tax dollars for the deposit, the first money in is free of tax. The growth will grow tax deferred, but when we reach the age of retirement, there are qualified distributions that will be coming out of that if it's structured properly, and you will have no tax on those qualified distributions. So the question is, would you rather pay tax on your after-tax deposits today, Or when you're retired, would you rather pay tax on not only the deposits but all the growth in the same time? So, when you put your money into an IRA or a 401k, is there really a tax savings? And no, we're simply delaying tax, which further compounds the tax problem. Not to mention, if we're invested in areas that are not protected investments, we could also have a partner called the stock market or the economy that could take away from our money as well. But we're talking strictly on a tax base today. Just wanted to throw that in. Question I'd ask for you is simply this. If you were a farmer, would you rather pay tax on the seed or the harvest from the planting of the seed? Naturally, I think most people would rather pay tax on the seeds they put in the ground and let the harvest be something we can use free. This is the tip today. I hope you enjoyed this. To learn more, follow the links on the website, and I look forward to chatting with you again and sharing some more tax tips and retirement tips with you. Again, this is Gary McCarty, the Indie Wealth Coach.